Hey everyone, happy Friday. We're going to have a little fun today. The last episode of this installment I did from my garage, as you know. And since we're all working remote, I figured let's go really remote. So today we're going to do the one from the nice, warm Caribbean sun. I think all of us would like to be on a warm, deserted island given everything that's going on right now. Plus, I figured this backdrop might help blunt the blow to some of the news I've got to give today. So let's talk about this week's big headlines. Obviously, unemployment claims, and then talk of this stimulus package being finalized. The unemployment numbers were horrific. The markets knew they were going to be horrific, but particularly to how it impacts mortgage rates is mortgage companies who own loans now have to be concerned about mortgage default rates increasing. So their mortgage loans for the last 5 years have been a pretty low risk investment, but with delinquency rates going up, with people being laid off and not being able to make their mortgage payments, they've got to account for that when thinking about buying new mortgages. If you went to a restaurant and got food poisoning, would you go back right away? Probably not, and that's what mortgage investors are having to think about right now. Now, the stimulus package, in theory, is supposed to offset that. The idea is to give homeowners mortgage payment forbearance, so not forgiveness, but more or less, hey, you get to skip this payment, or maybe the next 6 or 12 payments until you get back on your feet, and those payments get tacked on to the end of the loan. That all sounds great on the surface, but a big underlying problem that's going to cripple the mortgage industry if this passes as proposed is that the mortgage borrower gets to skip the payment, but the mortgage servicer, the company that you make your monthly mortgage payment to, whether it be a Wells Fargo or a Mr. Cooper or a Franklin American Mortgage Company or United Wholesale Mortgage, those mortgage servicing companies are contractually required to make their payments to their mortgage investors, the owner ultimately of the mortgage, which is most commonly Fannie Mae or Freddie Mac, regardless of whether the homeowner makes the payment or not. So you've got a homeowner who doesn't have to make the payment, but a mortgage servicer who does. And these mortgage servicers are not capitally structured to float potentially hundreds of billions of dollars in skip mortgage payments to these mortgage investors. There is no provision, as I understand it, that fixes this. Now, the Fed has come in and said, hey, no, we will provide a Band-Aid and provide credit lines to mortgage servicers if needed. And that might help stop the bleeding. But at the moment, mortgage servicing companies don't want to buy mortgages because they don't know how much risk they're going to be exposed to in this new world post, $2+ trillion stimulus package. So we've got, to keep it in a restaurant analogy, you basically have the government telling restaurants that they must provide free food to customers. And the restaurant still needs to buy the food to prepare and make and serve to their customers. So if you were a restaurant owner, you probably would just shut up shop, right? Because you don't want to invest in in food to not realize even enough money to cover the cost of that food. And that's what mortgage servicing companies are having to face now. Now, the Fed has shown that they are willing to step in as needed. If the last week is a telltale sign, it's very encouraging. They first said they were going to buy $200 billion over 6 months. They've done that in 2 weeks now. A real funny article written on Monday equated the Fed to being the Hulk and getting angry and just exerting its will on the markets in order to smash rates, mortgage rates specifically, down to an acceptable level. Well, if the Fed is the Hulk, then this proposed stimulus package as it's written is like the Marvel superhero Thanos, who basically sweeps the Hulk away with a prick of his thumb in one of the movies, because there's no amount of money that the Fed can pump into the mortgage market to take away the uncertainty and risk that mortgage servicers are currently faced. Here are a couple of very telling illustrations of this epic struggle that we're currently seeing between the Hulk, that is the Fed, and Thanos, who is the stimulus package that's trying to disrupt everything and overpower even the Hulk. So this graph shows what mortgage bonds are priced at over the last 3 months. So basically, the higher the price, the lower the interest rate that's being offered to you and me. And you can see right now we are at record levels. If we invert this graph, you'll see that rates should be lower than they ever have been due to, again, the Fed's involvement in buying an unprecedented amount of mortgage-backed securities. But if you translate that to really what's happening in the market for you and me, you can see that mortgage rates are not trending to all-time lows. We're having this very, bipolar experience of super low rates for a moment and then only to increase. Now, I will say these super low moments are happening on Monday mornings after a weekend of political news and interventions. So it seems like with each new week, there's renewed optimism in the mortgage market, only for it to wither away through the week. So it's going to be a really telling story as this unfolds. I'll obviously keep you continually updated on this and other developing stories. I'm optimistic that the feds will come in and save the day in this mortgage servicing crunch, which should push rates lower, barring any other new unprecedented market catastrophe that could push them higher, which, events like that are seeming to happen on a daily basis right now. So hang in there, stay safe, stay sane, and keep checking back in with me about mortgage rates and how they may create refinance opportunities for you in the near future. Have a great weekend. Bye-bye.